Welcome to the Hollow Point Trading Masterclass on options strategies. This is your complete playbook, covering every core strategy, from bullish and bearish to neutral and volatility, including construction, payoff, risk profiles, and the specific market conditions each is designed for. Let's get started. Here is our course map. We will begin with the essential foundations, move into directional plays, vertical spreads, and volatility strategies. We'll also cover neutral and income plays, and finally, time, ratio, and complex combinations to round out your trading arsenal. Why combine options into strategies? A single call or put is often a blunt instrument. By combining options, you can precisely shape your risk and reward profile, lower your overall cost, profit regardless of the market direction, or express a very specific market view. Every strategy in this video is built from these four fundamental blocks: long call, long put, short call, and short put. Mastering these four positions is the first step. All complex strategies are simply combinations of these basic pieces. Payoff diagrams are crucial. The dashed gold line represents your break-even point, where you have zero profit or loss. The green zone shows where you make money at expiry, the red zone shows where you lose, and the horizontal axis tracks the underlying price. Understanding cash flow is vital. A debit position means you pay money to open it, while a credit position means you collect money. Debit trades require large moves to profit, and usually see time decay work against you, whereas credit trades benefit from time decay and capped profits. The Greeks drive how your positions behave. Delta measures directional exposure, theta tracks the daily impact of time decay, vega captures sensitivity to changes in implied volatility, and gamma measures how fast your delta changes as the underlying price moves. Implied volatility, or IV, is a key decision factor. When IV is high, options are expensive, favoring selling strategies like credit spreads. When IV is low, options are cheap, making buying strategies like long calls or debit spreads more attractive. Every option premium consists of two parts: intrinsic and extrinsic value. Intrinsic value is the real, exercisable value, while extrinsic value, often called hope value, is driven by time remaining and implied volatility, eventually decaying to zero by expiration. Moneyness describes where the strike is relative to the current price. In the money, options have intrinsic value and act more like the stock. At the money, options have the most extrinsic value and time decay. Out of the money, options have no intrinsic value and are cheaper. The option chain is your menu. You'll want to focus on four key areas: the arrangement of calls and puts, bid-ask last prices for execution, IV and the Greeks for strategy selection, and open interest and volume to assess liquidity. Understanding expiration, exercise, and assignment is essential for risk management. Know when your contracts expire, understand how exercise works for long holders, and be prepared for potential early assignment if you are short in the money options. Delta is a powerful 2-in-1 number. It tells you your directional exposure, how much your position moves per dollar change in the stock, and acts as a rough proxy for the probability of an option finishing in the money. Finally, match your strategy to your market outlook. Whether you are strongly bullish, moderately bullish, neutral, or bearish, there is a specific family of strategies available to align your portfolio with your expectations. Now that we have covered the foundations, let's move into Part 1, Directional Plays. These single leg and stock-based positions are the building blocks that everything else is based upon. A long call is a bullish strategy where you buy an at or near the money call option. It gives you leveraged upside exposure if you expect a meaningful move up in the stock, while your potential loss is strictly limited to the premium you paid. The long put is the bearish counterpart. You purchase a put option, providing you with leveraged downside exposure if you expect the stock to drop. Like the long call, your risk is capped at the premium paid, making this useful as a directional hedge. For neutral to bullish outlooks where you own the underlying stock, a covered call is a great way to generate income. You hold 100 shares and sell a call against them, trading away some potential upside for immediate premium yield. A cash-secured put is another income-generating strategy. You sell a put option and set aside cash to buy the stock if it's assigned. Essentially, you're getting paid to set a price at which you'd be happy to own the shares. Protective puts are for when you are long a stock but concerned about market uncertainty. By adding a long put, you're essentially buying insurance, creating a hard floor on your losses while keeping your upside potential largely intact. A naked short call is an advanced high-risk strategy where you sell a call without owning the underlying stock. This has undefined risk, as there is no limit to how high the stock price can go. Most traders should opt for defined risk spreads instead. This summary of single-leg plays highlights the trade-offs. Always remember that defined risk means the absolute maximum you can lose is clear and capped before you enter the trade, which is a safer approach while you are still learning. Let's walk through the math of a long call. With stock at 100, you buy a 105 strike call for $3. Your risk is capped at $300. If the stock hits 115, your contract value grows, showcasing the power of leverage with defined risk. In this covered call example, You own 100 shares and sell a 105 strike call for 2.50 in premium. This generates immediate income and adds yield. Your upside is capped at 105, but you've locked in that premium as your return for the month. Welcome to Part 2, Vertical Spreads. By buying one option and simultaneously selling another at a different strike, you create a strategy with defined risk and defined reward. This is the true workhorse of professional directional trading. Vertical spreads all use the same expiration date, but different strikes. There are two primary types: debit verticals, where you pay to open the position, and credit verticals, where you collect premium to open the position. The second leg significantly lowers your overall risk. A bull call spread is a debit vertical used when you are moderately bullish. You buy a lower strike call and sell a higher strike call. This trade is cheaper than buying a single call and provides a defined, controlled reward. The bear put spread is the bearish equivalent of the bull call spread. You buy a higher strike put and sell a lower strike put. It is a cost-effective, defined risk way to profit from a move down in the underlying stock. A bull put spread is a credit vertical. You sell a higher strike put and buy a lower strike put, collecting a net credit up front. You win if the stock price stays above your short strike at expiration, effectively letting time decay work for you. Finally, the bear call spread. This is a bearish credit vertical, where you sell a lower strike call and buy a higher strike call. It is an excellent strategy when you expect the stock to stay below your short strike, generating income while capping your risk. When deciding which vertical spread to use, follow this rule of thumb. Buy debit spreads when options are cheap, meaning implied volatility is low, and sell credit spreads when options are rich, or when implied volatility is high. Let's look at a bull call spread. You buy a 100 strike call and sell a 110 strike call, paying a $4 net debit for a $10 wide spread. This controls $100 of upside for $400, targeting a clear move higher. Conversely, a bull put spread is a credit strategy. You sell a 95 put and buy a 90 put, collecting a 1.50 credit. You are paid to wait for the stock to stay above 95. Time decay is now your best friend. Now we enter Part 3, Volatility Plays. Straddles and strangles allow you to trade the size of a move rather than its direction. You go long if you expect fireworks, and short if you expect quiet. A long straddle involves buying both a call and a put at the same strike. It is a bet that the stock will make a significant move in either direction. Your max loss is the total premium paid. A long strangle is similar, but cheaper. You buy out-of-the-money calls and puts. Because they are further from the current price, the premium is lower, but you need a much larger move to become profitable. Short straddles are advanced, high-risk strategies where you sell an at-the-money call and put. You collect a large premium, hoping the stock pins the strike, but you face potentially unlimited risk if the market moves violently. A short strangle is the wider, slightly safer alternative to the short straddle. By selling out-of-the-money options, you widen your profit zone at the cost of collecting less premium up front. Comparing the two, straddles are at the money with higher cost and narrower break-evens, while strangles are out of the money with lower cost and wider break-evens. Your choice depends on your conviction and budget. Consider a straddle into earnings. You pay $12 for 200 strike calls and puts. You need a move greater than $12 to profit. But remember, the implied volatility crush after the news can easily erode your position. The earnings volatility crush is a classic trap. Before the announcement, IV pumps premium up, making options expensive. As soon as the results drop, IV collapses, and your long positions can lose value instantly, even if you guessed the direction correctly. Welcome to Part 4, Neutral and Income. Here, we look at strategies like iron condors and butterflies. These are designed to profit from a market that stays range-bound, using time decay to turn stagnant price action into consistent income. An iron condor is a defined risk income trade. You sell an out-of-the-money put spread and a call spread, creating a band of profit. You collect a credit and want the stock to stay between your short strikes. An iron butterfly is tighter. You sell a call and put at the same strike, and buy wings for protection. It offers higher potential credit than a standard condor, but creates a much narrower profit zone. Finally, the long call butterfly. This is a low-cost, defined risk trade, where you buy one lower call, sell two middle calls, and buy one upper call. It's perfect when you have a precise price target for expiration. This video covers the broken wing butterfly. This strategy is skewed neutral and involves longing a near call, shorting two middle calls, and longing a far call with a wider wing. Shifting one wing out often opens the position for a credit, which removes risk on one side of the trade. Now let's compare an iron condor to a butterfly. The iron condor provides a wider profit zone with a higher probability of profit, while the butterfly uses a single body strike for a more precise, pinpoint profit zone that typically offers a larger reward-to-risk ratio. Here is a worked example of an iron condor. With the stock at 100, we sell the 90 and 110 strikes and buy the 85 and 115 wings. This collects a 1.60 credit, creating a profit zone between 90 and 110. The takeaway is that this is a classic income trade with a defined risk band. When defending an iron condor, you should have a plan in place. Options include taking profit early at around 50% of the max credit, rolling the tested side to gain more room, rolling the safe side in to collect more premium, or honoring your stop if a loss limit is hit. Part 5 of this video discusses time and diagonal spreads. These strategies involve selling near-term options and owning longer-term ones to trade the calendar, effectively profiting from time decay and shifts in volatility. The calendar spread is a neutral, time decay strategy. It consists of selling a near-term option and longing a longer-term option at the same strike. You profit because the short option decays faster than the longer one you own. It is best used when you are neutral and want positive theta. A diagonal spread is a directional and time-based strategy. It involves selling a near-term option and buying a longer-term option at a different strike. It is essentially a calendar spread with a directional tilt, allowing you to roll the short leg over time. The poor man's covered call is a bullish income strategy. It uses a long, deep-in-the-money leaps call and a short, near-term, out-of-the-money call. This mimics a covered call, but requires significantly less capital than purchasing 100 shares of the underlying stock. Why do time spreads work? They rely on theta working in your favor, as the near-term option decays faster, and long vega, where the position benefits if implied volatility rises. However, the catch is that a fast move away from the strike or a volatility crush in the long leg can hurt the trade. In this calendar spread example, the stock is at 50. We sell a 14-day 50 strike call and buy a 45-day 50 strike call for a 1.10 debit. The profit peaks if the stock stays near 50 as the short option expires. This setup benefits from calm markets and an increase in implied volatility. Part 6 covers ratio and advanced strategies. These involve unequal leg counts and hybrid structures. These are powerful directional tools that are best mastered after you have a firm grasp of the basics. A call ratio backspread is a strongly bullish strategy. It involves shorting one lower strike call and longing two higher strike calls. This creates net long extra calls, offering explosive upside potential, often open for a credit. It is used when you expect a strong move up. The put ratio backspread is the bearish mirror of the call ratio. It involves shorting one higher strike put and longing two lower strike puts. This provides outsized move potential if the stock drops sharply. It is a leveraged, defined risk strategy used for downside exposure. The Jade Lizard is an advanced, neutral to bullish strategy. It consists of selling an out-of-the-money put and a call spread. By sizing the credit above the width of the call spread, you can carry zero upside risk while collecting premium in high volatility environments. Finally, Part 7 focuses on combinations and hedges. These strategies involve pairing options with stock or with other options to protect, replace, or fine-tune your overall position. This video covers the collar, a protected stock strategy. You hold 100 shares of the underlying, buy a protective put for a floor, and sell a covered call to finance that put. It's a bullish but protected position that caps your downside risk by trading away some of the potential upside. Next is the synthetic long stock, which replaces actual shares with options. By longing an at-the-money call and shorting a put at the same strike, you mimic owning the stock, but with far less capital. It offers unlimited profit potential but carries the same large downside risk as owning the shares directly. The risk reversal is a low-cost, bullish strategy. You sell an out-of-the-money put to fund the purchase of an out-of-the-money call. This creates a cheap, leveraged bet on the upside. You accept downside risk similar to owning the stock, but you've significantly reduced your initial capital outlay. Part 8. Putting it together. This final section connects everything we've discussed: strategy selection, understanding the Greeks, risk management, and the common mistakes that can quietly wreck even the most well-intentioned trades. Our strategy selector matrix simplifies the decision-making process. Ask yourself, what is your directional outlook, and is implied volatility high or low? Once you've chosen the strategy that fits, remember to always size your positions so that you never risk more than a small, fixed slice of your account. Understanding Greeks by strategy family helps you manage expectations. Generally, sellers want positive theta, letting time work in their favor. Conversely, buyers accept negative theta to gain positive vega and convexity, betting on a rise in volatility or a larger move in the underlying price. Choosing your strikes and expiration dates is all about tailoring the trade to your conviction. In-the-money strikes offer higher delta and more certainty, while out-of-the-money strikes are cheaper with larger potential payouts. Match your expiry to the catalyst you expect, keeping in mind how time decay affects your chosen strategy. Probability versus payout is the ultimate trade-off in options. High probability trades win often, but in smaller amounts, while high payout trades win rarely, but can yield significant gains. Both are valid, but your position sizing must remain disciplined to ensure you survive the losses that inevitably accompany either approach. The strategy family map organizes options into 6 core jobs: directional plays, verticals, volatility trades, neutral income strategies, time decay plays, and combinations for hedging. Identify the job you need to do, then use the current market volatility to select the specific structure that fits best. Part 9 focuses on managing the trade. Remember, entering is just the start. Successful trading comes from how you handle the position, sizing appropriately, taking profits, knowing how to defend a losing trade, and maintaining the discipline to exit when your plan dictates it. Effective risk management starts with sizing every position as a small, fixed fraction of your account. Always prefer defined risk strategies to cap your potential losses. Have a clear exit plan established before you open the trade, and focus on liquid underlyings to ensure you can enter and exit cleanly. To stay in the game, avoid these 6 common mistakes. Never sell naked, undefined risk options. Don't ignore implied volatility. Avoid holding to expiration due to gamma risk. Stay away from illiquid symbols. Never oversize your position. And always have a specific plan for how you will handle a trade that goes against you. Taking profits is a skill. The 50% rule, closing winners at about half of their maximum profit, is a popular approach. It avoids the high-risk, low-reward gamma of the final days before expiration, reduces your risk, and frees up your capital to be redeployed into new, high-quality opportunities. Rolling is a management tool, not a way to avoid losses. You can roll out in time to collect more credit or give the trade room, or roll up and down to recenter strikes around the current price. Just be careful that you aren't simply compounding your risk. When defending a tested strike, keep your head. You might roll for credit, reduce your position size to manage stress, turn the trade into a neutral structure like a condor, or simply accept the defined loss and reset. The key is to act on a pre-existing plan, not on impulse. Let's discuss assignment and exercise in practice. Short options can be assigned, so you must always plan for this to ensure it's never a surprise. If your short option is in the money at expiry, you should expect to fulfill the contract. Early assignment is possible at any time on in-the-money American-style options, especially around dividend dates. However, on strategies like cash-secured puts or covered calls, assignment often simply means your original plan is working as intended. To manage these situations proactively, consider closing or rolling your in-the-money short options before expiration if you do not want to be assigned shares. Moving to short-dated options, particularly 0 days to expiration or 0 DTE. These are powerful on indices like the SPX and NDX, but are notoriously unforgiving. Gamma is extreme here, meaning tiny price moves can swing your P&L violently. Theta decay is brutal for late buyers, but beneficial for sellers. Given the massive leverage involved, you must size down and use hard stops. There is no time to think mid-trade, so define your entry, target, and stop before the bell. Understanding long versus short premium mindsets is key. Long premium means you paid and need a move. Your success hinges on volatility or price movement. Short premium means you collected credit and need calm, benefiting from stillness or volatility contraction. Many option buyers struggle because they fight 3 headwinds: theta bleed, volatility risk, and the need for perfect timing. The fix? Use spreads to offset decay, trade when implied volatility is favorable, and strictly respect your position sizing. Execution is crucial. A great idea dies on a bad fill. Focus on assets with tight bid-ask spreads and real volume or open interest. Use limit orders to work the mid-price, and stick to liquid names to avoid getting trapped. Synthetics and put-call parity show us that calls, puts, and stock are interchangeable building blocks. Knowing these relationships helps you find the most efficient way to express a view, spot mispricings, or understand complex structures like reversals and collars. Discipline in position sizing is non-negotiable. Only risk a small, fixed fraction of your account on any single trade. Watch out for correlation across your portfolio, and keep enough dry powder to defend or adjust your positions when necessary. At Hollow Point Trading, we use a 3-step lens for strategy selection. Check the macro backdrop, look at fundamentals for catalysts, and use technical levels for strikes. The structure is always the final piece of the puzzle. Here is a quick recap of the playbook. Every strategy uses 4 basic legs. Debit requires movement. Credit requires stability. Always check IV, use verticals for defined risk, and understand that butterflies and condors harvest time decay. For quick reference, remember our key definitions, from Greeks like delta and vega to concepts like assignment and leaps. Mastering this vocabulary is the foundation of clear trade planning. Keep learning with Hollow Point Trading. We offer live callouts, structured education, and a comprehensive framework designed for real market conditions. Visit our website, YouTube, or Discord to continue your journey. Finally, a reminder, this content is for educational purposes only. Options involve substantial risk and are not suitable for everyone. Always do your own research or consult a licensed professional before trading.